Subscribe to LearnCab and hit the bell icon to get notified.
Hello friends, welcome to the amendment lecture on GST as applicable for CA Intermediate for May 2022 examinations. Friends, the amendments from 1st of May 2021 till 31st of October 2021 as covered by the statutory update of ICI has been covered in this amendment series. I wish you a very happy learning. Friends, before we proceed further, let's have a look at few of the exclusions which are not a part of your syllabus as compared to the previous attempts wherein it was a part of your syllabus. Friends, Schedule 3, para number 7 and para number 8 is not a part of your syllabus. So friends, Section 7 which defines the scope of supply, it gives a reference to Schedule 3 wherein in Schedule 3 various activities and transactions are listed which are neither a supply of goods nor a supply of services. Schedule 3 contains 8 paragraphs, out of which para 7 and para 8 is not a part of your syllabus. Only para 1 to para 6 is a part of your syllabus. Reverse charge mechanism. Now friends, notification number 10/2017 integrated tax rate. It lists out, it notifies various services which are liable to be taxed under reverse charge mechanism according to 5 subsection 3 of the IGST Act. Now friends, amongst the various services which have been notified, there is one service which has been notified which is not a part of the syllabus, and that particular service is services of transportation of goods by a vessel from a place outside India to India. This particular service is liable to be taxed under reverse charge mechanism under the IGST notification 10/2017 integrated tax rate. This particular service which is notified for liable to be taxed under RCM under this IGST notification is not a part of your syllabus. Notified services for 9 subsection 5. Now friends, e-commerce operator. For certain services which are notified under 9 subsection 5 of the CGST Act and also under 5 subsection 5 of the IGST Act, certain services have been notified wherein the electronic commerce operator is liable to pay taxes. Those services which are notified are not a part of your syllabus. Friends, please understand, 5 subsection 5 of IGST law and 9 subsection 5 of the CGST law, they are a part of your syllabus. However, what are the services which are notified wherein ECO is liable to pay taxes? Those notified services are not a part of your syllabus. Rule 42 and Rule 43. This gives a mechanism wherein proportionate credit could be availed in a case where input services and capital goods are partly used for business purposes and partly for non-business purposes, partly for making taxable including zero rated supplies and partly for making exempt supplies. Now what is the mechanism to compute this proportionate credit? This mechanism is detailed in Rule 42 and 43. This Rule 42 and 43 is not a part of your syllabus. Few general guidelines before we start up. Friends, for LearnCab students, the lectures are already updated in the portal. However, I would recommend you to watch this amendment lecture series at one shot either in the portal or in the YouTube so that you get a grip over all the amendments which are made. Amendment notes are attached. You can download them and have a look for quick reference. Approach. Friends, we are only going to discuss about the change aspect. So therefore, I would be presuming that you are already aware of the basics. Even though we would be discussing the background which led to this change, but still I would be going with the presumption that the basics you are already aware of so that you are able to appreciate the change in a much better manner. Friends, books. Those who wanted to order the books, they could visit this website. The books which are available is Study Revise Crack. It is a detailed module covering the entire syllabus. Then you have Question Bank which is named as Train Your Brain, a comprehensive question bank covering all the models of questions. And you have a book called as QR Infographics which is nothing but your summary charts for quick conceptual revision. So if you want to place order, you can visit this website and place your order. Amendment in ITC 04. Now friends, according to section 19, a principal can send the goods to a job worker, be it inputs, be it capital goods. He can send the goods to a job worker without payment of taxes. However, he needs to file a return. He needs to file a return called as ITC 04. ITC 04 contains the details of goods sent by the principal to the job worker and also the goods which are received back by the principal from the job worker. According to rule number 45, prior to amendment, ITC 04 happened to be a quarterly return. ITC 04 happened to be a quarterly return. The due date was 25th of the month following the end of the quarter. Post amendment, ITC 04, the frequency and the due date of ITC 04 depends on the turnover of the principal. So the revised due dates and the revised frequency is as follows. If the aggregate turnover of the principal in the preceding financial year, if the aggregate turnover of the principal in the preceding financial year, if it was up to rupees 5 crores, then ITC 04 is an annual return. It just needs to be filed once in a financial year. Throughout the financial year, all the goods which were sent by the principal to the job worker and also the goods were received back by the principal from the job worker. For throughout the financial year, one ITC 04 needs to be filed. And what is the due date? The due date is 25th of April following the end of the financial year. Say for example, for financial year 21-22, the due date for ITC 04 would be 25th of April 2022. Now, if the turnover of the principal in the preceding financial year exceeds 5 crore rupees, then ITC 04 is a half yearly return. So for April to September, there is going to be one ITC 04. For October to March, there is going to be another ITC 04. What is going to be the due dates? The due dates for ITC 04 April to September. Say for example, for financial year 21-22. So from April 2021 till September 2021. The due date for this half yearly ITC 04 is going to be 25th of October 2021. Similarly, for October 2021 to March 2022, for this portion of the financial year, for this half yearly ITC 04, the due date happens to be 25th of April 2022. So friends, the changes prior to amendment, ITC 04 used to be a quarterly return. Post amendment, ITC 04 depends, the frequency and the due date depends on the turnover of the principal, If the aggregate turnover of the principal in the preceding financial year, if it was up to 5 crore rupees, then it is an annual return. Due date is 25th of April following the end of the financial year. If the turnover of the principal happens to be more than 5 crore rupees, if it is exceeding 5 crore rupees, it is a half yearly ITC 04. The due date happens to be for the first half 25th of October. For the second half, it happens to be 25th of April. Amendment in 48 sub rule 4, a class of notified registered persons. Friends, according to 48 sub rule 4, a class of registered persons would be in a position to issue a tax invoice only after obtaining an invoice reference number, from the common portal. This invoice reference number needs to be embedded in a QR code, and this QR code needs to be present in the tax invoice as a content of tax invoice according to rule number 46. So now friends, who are those class of registered persons who are notified for the purpose of e-invoicing under 48 sub rule 4? Those persons who are required to obtain invoice reference number from the portal. Who are those class of registered persons who have been notified? That notification was there in 13/2020. 13/2020 notified those class of registered persons for the purpose of e-invoicing provisions 48 sub rule 4. It simply told you that all those registered persons whose aggregate turnover in any preceding financial year from 17-18 onwards, if it exceeded 50 crore rupees, the provisions of 48 sub rule 4 would be applicable. And it would be applicable for B2B supplies and also for exports. However, prior to amendment 13/2020 excluded two categories of persons. So which means for these two category of persons who are excluded from 13/2020, e-invoicing provisions would not be applicable. Who were those two persons? One, it was a special economic zone unit, not a special economic zone developer. Mind you, the wordings were very clear, special economic zone unit. And the next one was those persons who are referred in 54 sub rule 2, 3, 4 and 4A. Those persons who have got some specific relaxation, specific points as far as contents of tax invoice was concerned. There were those persons, that is insurer, banking company, supplier of passenger transportation services, GTA and multiplex screens. So these two persons were excluded from e-invoicing provisions. Now there is an amendment to this list. There is a third category of person. There is a third person who has been included, which is government department and local authority. So therefore friends, e-invoicing provisions are not applicable. E-invoicing provisions are not applicable to government department and local authority. So as to say, if there is a government department, if there is a local authority who is making supplies, and even if their aggregate turnover in any of the preceding financial year from 17-18 onwards, even if it has exceeded 50 crore rupees, they need not obtain an invoice reference number from the common portal. For the government department and local authority, 48 sub rule 4 e-invoicing provisions are not applicable. So this list of 2 now gets increased to list of 3 by inclusion of government department and local authority. For them, 48 sub rule 4 provisions are not applicable. A few changes in the manner in which authentication of return filing, authentication of applications which is being filed on the common portal is being done. Now friends, as we all know, all the applications and all the return filing which is being done, it is electronic, it needs to be done through the common portal. Manual applications, manual return filings are not allowed. So since now the applications and return filings are electronic, it also needs to be signed, it also needs to be verified electronically. So authentication of those filings which is being done also needs to be electronic mode. So friends, what were the various electronic modes which are available? The applications which are being filed, the returns which were being filed could be authenticated by 2 modes. One, it was through digital signature. 2, it was through OTPs. Now OTPs could be Aadhaar based OTPs, and OTP will be going to the mobile number which is registered in the Aadhaar database, or it could be OTP being sent to the registered mail ID and registered mobile numbers of the authorized signatory as per the information which is available in the common portal. So it could be through digital signatures, it could be through OTPs. Now friends, as far as companies were concerned, for them, the manner of authentication of applications, be it refund application, registration application, or any other application, or be it return filing, the manner which was allowed was only through digital signature. For them, OTP based authentication was not allowed. However friends, due to work from home during COVID scenario, in such a case, it became mandatory for the government to allow authentication through OTP as well, because digital signature could be in office, whereas returns and other applications are being filed remotely from a place other than office. So therefore friends, for time being, for certain period of time, OTP based authentication was extended to companies as well. However, the relief which was extended was only temporarily. Now this temporary relief has been made permanent. Rule number 26 has been amended to state that all applications which are being filed on the common portal, be it registration, be it return filing, be it refund application, be it any other application which is filed on the common portal, all persons including companies can authenticate that said application, the said return filing through OTP as well. So friends, the restriction which was there, that the companies can validate their forms, the companies can validate their applications only through digital signature, has now been removed. Even though the companies can now authenticate, can validate their returns, their applications through OTPs. Now friends, amendment in 35 subsection 5. There was a section called as 35 subsection 5 which has been omitted. Now friends, as we all know, returns under GST, there are periodical returns under GST. The periodical returns, we have GSTR 1, we have GSTR 3B, we have GSTR 4, and there are various periodical returns. And also there are other returns under GST. Now other returns, an example could be annual return, which is nothing but a summation of all the periodical returns which are being filed. Audit under 35 subsection 5. Friends, 35 subsection 5 has been omitted. Now what was 35 subsection 5? 35 subsection 5 stated that all those registered persons whose aggregate turnover exceeded a threshold, they need to get their accounts audited by a chartered accountant or by a cost accountant, and they need to file a reconciliation statement in form GSTR 9C along with the annual return which is going to be filed under section 44. So what is that reconciliation statement? This reconciliation statement would reconcile the value which is furnished in the GST returns vis-a-vis the value which is available in the audited annual accounts. Now friends, what was the threshold? As we discussed, all those registered persons whose aggregate turnover exceeded a threshold needs to carry out an audit, needs to get audit done under 35 subsection 5. So friends, what was the threshold? The threshold, it was referred in rule number 80. The threshold was initially kept as 2 crore rupees. Later on, for the financial year 17-18, 18-19 and 19-20, they increased this threshold from 2 crore rupees to 5 crore rupees. So friends, in essence, the situation was all those registered persons whose aggregate turnover exceeded 5 crore rupees should have filed along with GSTR 9 the annual return. They should have also filed GSTR 9C, which was a reconciliation statement, which was to be certified by the professionals, chartered accountants, or by the cost accountants. So now friends, this particular issue was highlighted to the government as though it is a cost intensive exercise. The value addition which is coming out of this GSTR 9C is not worth the cost which is involved. It is the revenue collections which are there. It is not worth as compared to the cost which was involved by getting the work of GSTR 9C being done by these professionals. So therefore the matter was not put up in the appropriate manner in which it should have been presented. So therefore the government has decided to omit 35 subsection 5. So now friends, the position is something like this. Along with GSTR 9 annual return which is going to be filed under section 44, there is still a reconciliation statement GSTR 9C which needs to be filed, which needs to be furnished. It is still applicable for those persons whose aggregate turnover has exceeded 5 crore rupees. But now this reconciliation statement which is there, it has to be self-certified. Certification need not be obtained for a professional. The registered person can self-certify this GSTR 9C and he can upload it. This 35 subsection 5 has been omitted. So friends, rule section 44 which speaks about annual return, that also has been replaced. Rule 80 also has been amended. So friends, 35 subsection 5, the omission, we'll just have a look at it. Every registered person whose turnover during the financial year exceeds the prescribed limit shall get his accounts audited by a chartered accountant or a cost accountant and shall submit a copy of audited annual accounts, the reconciliation statement under 44 subsection 2 and such other documents in such form and manner as may be prescribed. So this now goes away with, so you do not have to furnish a reconciliation statement which is certified by a professional. Self-certified reconciliation statement would be sufficient. Provided, the proviso, provided that nothing contained in this subsection shall apply to any department of central government, state government, local authority whose books of account are subject to audit by Comptroller and Auditor General of India, or an auditor who is appointed for auditing the accounts of local authorities under any law for time being in force. So friends, in short, for the departments of the government and the local authorities, for them, even when 35 subsection 5 was in force, reconciliation statement was not required to be furnished. All that they required was to file GSTR 9 annual return under section 44. Now friends, this 35 subsection 5, this proviso, since 35 subsection 5 itself has been omitted, since 35 subsection 5 itself has been omitted, this proviso has been taken care of in section 44. This proviso has been taken care of in section 44. Now friends, what is the difference? The difference is prior to amendment. Prior to amendment, these departments, for them it was sufficient to file GSTR 9. GSTR 9C is not required to be filed. What is the effect after amendment? Friends, after amendment, GSTR 9 itself is not required to be filed. I repeat, prior to amendment, these departments should have filed 9. 9C was not required. After amendment, as we are now going to see section 44 in detail. Friends, the amendment, what we have discussed is only so much. Since section 44 has been replaced totally, we are just going to read section 44 in a detailed manner. When we are going to read section 44 in a detailed manner, you will get to know that prior to amendment, these persons, that is these departments, were supposed to file 9. 9C was not required because this proviso is there in 35 subsection 5. After amendment, this proviso is now placed in section 44 of annual return itself, which means that these persons are not required to file GSTR 9 as well. So friends, we are now going to have a look in detailed manner of section 44 which has been substituted. We also are parallelly going to look into rule number 80 which speaks about the threshold which is there in section 44. Annual return, final return and return of an UIN. Now friends, what is an annual return? The various periodical returns which you have filed, all those you need to accumulate. You need to make a summation of it and give it in a single return. So annual return is nothing but a summation of the periodical returns which you have filed. Now friends, what are the periodical returns which are supposed to be filed? The periodical returns which are supposed to be filed, you had GSTR 1 and GSTR 3B. That was for a regular person, including a casual taxable person. casual taxable person, friends, if you could recollect, there was no separate return for a casual taxable person. Whatever is the return which is a regular person is going to file, the same returns needs to be filed by a casual taxable person as well. Then GSTR 4 for a person who is paying taxes under section 10, GSTR 5 for NRTP, GSTR 5A, OIDR fellow sitting outside India making supplies to non-taxable online recipient. You have GSTR 6, input service distributor, GSTR 7, TDS returns, GSTR 8, TCS returns. So all these are periodical returns which are supposed to be filed. And as we discussed, what is an annual return? Annual return is the data which you have given in various periodical returns. You need to make a summation of it and you need to file it in a single return called as annual return. So annual return is a cumulative effect of the periodical returns which you have filed. So now friends, let's have a look at who is the person who should file this annual return. So it says every registered person other than a casual taxable person, non-resident taxable person, input service distributor, a person who is paying taxes under section 51 or under section 52. So friends, these are the various periodical returns which we have seen. Out of these, who is the person who is supposed to file annual return? So it says a person other than a casual taxable person. So friends, this is the first time where a casual taxable person is being separated from a regular person. This is the first time where a casual taxable person is being separated from a regular person. In this case, a casual taxable person need not file annual return. The reason also is very simple because friends, at the end of this financial year, the annual returns are normally going to be filed after the close of the financial year. By that time, this casual taxable person would not even be available in that particular state or union territory. So therefore friends, who is the person who is supposed to file annual return? First, friends, please understand the flow very carefully. First, we just discussed the general concept. What is the annual return? It is a summation of periodical returns which are being filed. Step number 2, we have seen a list of what are the periodical returns which are being filed. We listed out those things. Now we are seeing who are the persons who are supposed to file annual return. It says every registered person other than a casual taxable person. So casual taxable person need not file annual return. Non-resident taxable person. So 5 also is ruled out. Person whose input service distributor, 6 is ruled out. A person who is paying taxes under 51 and 52, 7 is ruled out, 8 is ruled out. So friends, who are the persons who are supposed to file annual return? You have 1 and 3B, that is your regular return. And then GSTR 4, who is this GSTR 4? He is a composition tax. This is a composition taxable person, a person who is paying taxes under section 10. And then you have GSTR 5A, that is an OIDR person who is sitting outside India and making supplies to a person who is a non-taxable online recipient. So therefore friends, the equation forms ROC. Who should file annual returns? ROC should file annual return, and in this case, this R would not include a casual taxable person. Regular persons other than casual taxable person, a person supplying OIDR services from non-taxable territory to an NTOR, and a composition taxable person. ROC are the persons who are supposed to file annual return. In which forms we are going to see. So friends, please understand section 44, who should file annual return? ROC should file annual return. Regular persons other than casual taxable persons, OIDR fellow from outside in non-taxable territory to non-taxable online recipient, and composition taxable person. They shall furnish an annual return which may include, it is discretionary, a self-certified reconciliation statement. So along with the annual return, what needs to be given? A self-certified reconciliation statement needs to be given. Now what is a reconciliation statement? It would reconcile the value of supplies which is declared in the return furnished for the financial year with the audited annual financial statement for every financial year electronically within such time and in such form and in such manner as may be prescribed. So friends, section 44 is speaking about two things. One, it is speaking about annual return. Who should file this annual return? It is ROC. R would not include a casual taxable person. Now, along with this annual return, it may include, what is meant by may? It is discretionary, which means that only for a certain class of registered persons, this reconciliation statement needs to be given. Who are going to be those class of registered person? We'll be seeing them in the rules. So friends, it may include a self-certified reconciliation statement. It need not be certified by any other person. It is self-certified, which means it need not be certified by a qualified chartered accountant. It need not be certified by a cost accountant. It is self-certified reconciliation statement. What is this reconciliation statement? It is a reconciliation between the value of supplies which is declared in the returns which are furnished for the financial year, which means in the periodical returns which are furnished in the financial year, along with the audited annual financial statement for every financial year. So friends, you have one set of data which is given to the GST portal. You have another set of data which is lying in your audited annual financial statements. So between these both, whatever is the difference, you need to give the reason for the difference. That is meant by reconciling the audited annual financial statements vis-a-vis the data which is given to the GST portal. Now friends, please tell me, in an ideal scenario where you have filed your GST returns pakka without any mistake, zero error, if you have filed your GST returns error free, would there be any difference between your audited financial statements vis-a-vis the data which is given in the GST returns? The answer is yes. Even though you might have been extremely cautious while filing your GST returns and filed all the GST returns as per law, still there are bound to be differences between the GST data which you have furnished in the portal vis-a-vis the data which is there in your audited financial statements, because the language which both of these understand, the law which both of these follow are totally different. Let's take two little examples. Let's suppose there is a stock transfer which has taken from one branch to another branch which is there in the same PAN number. For them, there is going to be a single profit and loss account. There is going to be a single financial statement. Now friends, assuming the stock is still lying, please understand, the stock is still lying within the same entity. It has not been given, it has not been sold outside. But however, it is a supply according to the GST law. So therefore, in this particular case, one branch, when it is supplying to another branch, it would be treated as a supply according to GST law, but it is not going to be treated as a sale as per the accounting standards which are available. So therefore, this will not reflect in your audited annual financial statements. So therefore, there is a difference, and the reason for the difference is also available. Let's take another case. Let's suppose some capital goods are being sold. In your audited financial statements, only the profit or loss would be recognized as the revenue. But however, as far as GST law is concerned, it is not concerned about profit or loss. It would recognize the transaction value at which it is being supplied. There is going to be a difference for it. Likewise, there could be n number of examples where, because of the different laws which are applicable, because of the different recognition treatments which are available, there is bound to be the difference between the data which is given in the GST portal vis-a-vis the data which is presented in the audited annual financial statements. So therefore, these differences needs to be reconciled, and this reconciliation statement needs to be self-certified by everybody who is going to file an annual return. The answer is no. Only by few of them. Who are few of them? That will be seen a little later on. So friends, as of now, what we understand, who are the persons who are liable to file annual return? All you need to remember is ROC. What is our regular person? Does it include a casual taxable person? No. First time casual taxable person and regular person are being separated. What is O? It is OIDR fellow from non-taxable territory making supplies to a non-taxable online recipient. What is C? He is a composition taxable person. Next one. There is a proviso which is there to section 44. This proviso states that the commissioner may, on the recommendations of council, by notification, he may exempt any class of registered persons from filing annual return under this section. And friends, accordingly, under this proviso, there is a notification 30/2019 which is being issued, wherein OIDR services from a place outside India to a non-taxable online recipient, this particular person is exempted from filing annual return. Friends, please understand, in the earlier slide what we had discussed, we have seen ROC, which means that who is this O person? It was the person who was supposed to file GSTR 5A. According to section 44, OIDR fellow sitting in non-taxable territory making supplies to non-taxable online recipient is also a person who is going to file, who is supposed to file annual return. But however, there is a proviso to section 44 wherein it states that the commissioner can notify a class of registered person who did not file GSTR 9, and the commissioner has notified this OIDR from entity to NTOR is not required to file an annual return. So friends, what is the combined effect? The combined effect after reading the proviso is who is supposed to file an annual return? It is only RC. It is only RC, and R excludes a casual taxable person. The next proviso reads that provided further that nothing contained in this section shall apply to any department of the central government, state government or local authority whose books of accounts are subject to audit by the Comptroller and Auditor General of India, or an auditor who is appointed for auditing the accounts of local authorities under any law for time being in force. So friends, now the second proviso is not authorizing the commissioner to notify anyone. Second proviso itself is saying that these persons are not required to file annual return. Friends, please understand, when these persons are not at all required to file annual return, naturally they are also not required to file the self-certified reconciliation statement. I repeat, when these particular persons are not required to file annual return at all, there is no requirement for them to file self-certified reconciliation statement, because these self-certified reconciliation statements are filed along with annual return. So when there is no annual return, there is no self-certified reconciliation statement. So friends, what is the final conclusion? Final conclusion is RC. This R would exclude casual taxable person. It would also exclude, this R would exclude casual taxable person. I repeat, the equation is RC. This R would exclude casual taxable person. C means a composition taxable person, a person who is paying taxes under section 10. Now, in this person also, another category of persons. Amongst this, another category of persons who are excluded is the department of government, be it central government, be it state government, be it a local authority, whose books of accounts are audited by Comptroller, Auditor General of India, or any other auditor who is appointed to audit the accounts of local authorities. If this is the case, they need not file GSTR 9. What is the form? They need not file the annual return. What is the form? The regular taxable person under section 9, they need to file it form GSTR 9. GSTR 9 is the annual return, the form in which it is going to be filed. Taxable person under section 10, the composition taxable person, he needs to file it in GSTR 9A. Friends, strictly speaking, GSTR 9A is not required. Practically, it should not be required because, friends, what is GSTR 9A? GSTR 9A, it is an annual return. What is an annual return? It is the summation of periodical return which is going to be filed. Now friends, please tell me, how many periodical returns does a composition taxable person file? He files only one periodical return. He files GSTR 4, which is an annual affair. CMP 08, through which he is going to make quarterly payments. These are all only modes for making payment. They are not returns. CMP 08 is not a return. The return which is being filed is GSTR 4, which is already filed only once in an annum. It is effectively, this itself is an annual return because it is being filed only once per annum. But however, the law is as such. It could be amended in future, but however, as of now, a composition taxable person files GSTR 4. It is a composition taxable person's return. He files GSTR 4 once in a year. Also, he files an annual return in GSTR 9A. Frequency for annual return, it is yearly. The due date, it is 31st of December of the succeeding financial year. Let's suppose for financial year 21 and 22, it is going to be 31st of December 2022. So this is going to be due date. Reconciliation statement. Who should file the reconciliation statement? As we discussed, this reconciliation statement was optional when we are seeing section 44, which means certain persons would be notified who are supposed to give this self-certified reconciliation statements. What is that reconciliation statement going to do? It is going to reconcile the values which are declared in the returns furnished under GST vis-a-vis the audited annual financial statements. Reconciliation statement, a registered person who is required to file GSTR 9. So therefore, if a person is not required to file GSTR 9, There is no requirement to file this self-certified reconciliation statements as well. OIDR person who is sitting in non-taxable territory to an NTOR is not required to file GSTR 9. Therefore, not required to file this reconciliation statement as well. Similarly, the government departments whose books are audited by the Comptroller and Auditor General of India, they need not file GSTR 9. So similarly, they also need not file these reconciliation statements. So a registered person who is required to file GSTR 9 whose aggregate turnover during the financial year exceeds 5 crore rupees shall also furnish a self-certified reconciliation statement as specified under section 44 in form GSTR 9C. So what is the form for reconciliation statement? It is 9C. Along with annual return on or before 31st of December following the end of such financial year. So friends, what is the statement through which reconciliation statement is being filed? It is GSTR 9C. Who needs to file them? It is all those registered person whose aggregate turnover exceeds 5 crore rupees. All those persons whose aggregate turnover exceeds 5 crore rupees, they need to file this reconciliation statement. Should it be filed by everyone? The answer is no. There are two-step criteria which we need to check. First, he should be a person who is liable to file GSTR 9. Second, he should be a person whose aggregate turnover during the financial year for which he is going to file GSTR, this reconciliation statement, it should exceed rupees 5 crores. What is the due date? It is again 31st of December. It is having the same due date as GSTR 9.
Subscribe to LearnCab and hit the bell icon to get notified.